In September 2000, two founders of a struggling DVD by mail startup took the elevator to the 23rd floor of the Renaissance Tower in Dallas. They offered to sell their company, Netflix, to Blockbuster for $50 million. Blockbuster's executives laughed them out of the room. That laugh is usually framed as a massive corporate blunder, but looking at the balance sheets from that exact afternoon reveals something else. Passing on Netflix was the most mathematically sound decision Blockbuster could have made. If rejecting Netflix wasn't the fatal blow, we have to look deeper to see what actually brought down a $5 billion empire. The total collapse of Blockbuster offers a precise blueprint for exactly how industry titans rot from the inside out. Blockbuster didn't lack futuristic vision. They simply had zero incentive to purchase a cash-hemorrhaging competitor right as the dot-com bubble was bursting. In the year 2000, Blockbuster generated nearly $5 billion in revenue. They controlled thousands of physical retail locations and had a fiercely loyal base of 20 million active users. Netflix, meanwhile, was a desperate mail-order startup bleeding $50 million a year. Their early DVD by mail model required huge postage costs and expensive distribution centers. It was a logistical nightmare that burned through cash at an alarming rate. For Blockbuster's leadership, acquiring Netflix wouldn't have been buying an asset, it would have meant taking on a massive liability. Instead of looking at technology to understand Blockbuster's demise, we need to look at their basic economics. Their core financial philosophy relied on a concept called managed dissatisfaction. This chart breaks down Blockbuster's year 2000 revenue. Here, we see an estimated $800 million generated entirely by late fees. The profit margin relied on this single structural pillar. Their financial health depended on penalizing their most frequent, loyal customers. These penalties generated massive short-term cash, but they also created deep resentment among users. More dangerously, this reliance on fees masked a hidden financial anchor that would soon paralyze their ability to innovate. In 2004, Blockbuster was spun off from its parent company, Viacom. As part of that separation, Viacom saddled Blockbuster with nearly $1 billion in corporate debt. At the exact same time, Blockbuster's internal technology was decaying. Their core operating systems were still running on ancient Fortran code. Servicing that massive debt load drained Blockbuster's cash reserves. The math was unforgiving. They simply didn't have the capital to rewrite their software or secure exclusive digital streaming rights. Yet, despite operating with a crippled balance sheet and ancient infrastructure, Blockbuster's leadership engineered a counteroffensive in 2006 that actually started crushing Netflix. They launched a program called Total Access. Users could rent a DVD online, receive it in the mail, and then return it to a physical Blockbuster store for a free, immediate rental right off the shelf. This dual-line graph tracking 2006 to 2007 subscriber trends shows the immediate impact. Blockbuster's line rockets upward, adding 2 million new subscribers at lightning speed. Looking at the bottom axis, Netflix lost 55,000 subscribers in a single quarter. Total Access was eating into their base. Blockbuster had neutralized the Netflix threat. They found a hybrid model that worked, right before a billionaire investor decided to tear the company apart from the inside. That investor was Carl Icahn. He orchestrated a hostile boardroom takeover, aggressively moving to change the company's direction. Icahn viewed the Total Access program as an unsustainable money loser. More importantly, he despised the fact that Blockbuster had eliminated its highly lucrative late fee model to compete with Netflix. A swift internal purge followed. CEO John Antioco was ousted, James Keyes took his place, and the online strategy was gutted. They brought late fees back. That decision instantly killed their subscriber growth and permanently alienated whatever customer goodwill they had left. Blockbuster explicitly chose short-term penalty revenue over long-term digital survival. They snatched defeat right out of the jaws of victory. Moving into the late 2000s, there is a lingering misconception that Netflix's 2007 pivot to digital streaming was the bullet that finally killed Blockbuster. It wasn't. The fatal blow came from Hollywood. The major movie studios grew deeply spooked by Blockbuster's towering debt load. They suddenly abandoned their standard 90-day credit terms and demanded cash up front for all new movies. This caused a complete collapse of what retailers call asset turns. Without that 90-day operational oxygen, Blockbuster simply couldn't afford to stock its own shelves with new inventory. Starved of cash and unable to offer new releases, Blockbuster officially filed for Chapter 11 bankruptcy in 2010. It was a failure of the balance sheet, not a lack of foresight, that forced the final closure. The true autopsy report is clear. Netflix didn't murder Blockbuster. Blockbuster's executives handed Netflix the weapon, loaded it with $1 billion of corporate debt, and pulled the trigger by clinging to late fees. In an ironic postscript, ousted CEO John Antioco took his severance package, invested it directly into Netflix stock, and quickly doubled his money. A financial model built on punishing its own customers cannot survive the exact moment a frictionless alternative arrives in the market. Blockbuster didn't die because they failed to buy the future. They died because they couldn't afford to let go of the past.